Hello, and welcome back to the What's Up with Real Estate Show. And well, mortgage rates are still stuck in the mid sixes. Inflation just popped again, and new home sales, well, we're going to talk about that. So the question this week is simple. Are we looking at more pain, or are we close to the point where rates might finally start following inflation lower? Probably not. Welcome to the What's Up with Real Estate Show, your weekly strategic housing market briefing for buyers, sellers, homeowners, and agents trying to make smarter decisions in an otherwise confusing market. Today, we're covering three things, not two things, three things. Number one, first, why mortgage rates haven't followed oil prices. I think we all know the answer to that. Second, why new home sales are slowing. Third, why inflation may have already peaked. Fingers crossed. And stick around for the mortgage tip and money tip because we're breaking down a question every buyer should understand. Fixed rate versus adjustable. It's because not everyone likes change, especially when change comes with a monthly payment. So before we get started, drop a comment. Do you think rates are going lower, higher, or staying stuck? Moving on to talking point number one with our Let's Go CPT Soul, who knows almost everything except for what I know. And so we are going to discuss rates and start to follow oil. Hopefully, eventually. Freddie Mac's primary market survey shows the 30-year fixed rate mortgage at 6.49 as of June 25th, 2026. Still pretty high, especially compared to the 5.98 that we had for one day in February until we declared war on somebody on the other side of the planet. Now, here's the interesting part. Oil prices have moved lower as geopolitical tensions have cooled. At least that's what we hear, but mortgage rates haven't really lowered yet. Why? Because mortgage rates don't follow oil. They follow the bond market. And right now, the bond market is still worried about inflation. Quick question. Hawkish means, or quick translation, hawkish means the Fed is more worried about inflation than growth and may keep rates higher longer. And that's where I believe we are at. So even if oils falls, mortgage rates may not fall immediately. So
Exactly. Markets need to see solid proof inflation is tamed before rates budge. It's all about expectations first, confirmation next. Patience, just like a mortgage, is key.
Yeah. And here in Houston, across Texas, it really matters because affordability is still the gatekeeper. Buyers may see more listings, may even have more seller flexibility. But if rates stay in the mid sixes, monthly payments still are under pressure. For agents, this means strategy matters more than optimism. You can't tell buyers rates will come down. You need to help them model the monthly mortgage payment and, hey, refinance later. And share with them the risk of waiting. Prices go up 5% on an annual basis almost, and we have the data for nearly 100 years. Buyers and agents, what are you seeing right now? Are buyers waiting for lower rates, or are they adjusting and moving forward anyway? And while rates are testing patience, new home sales just gave us a pretty clear affordability signal. And this headline sounds negative, and honestly, it is. New home sales fell in May to an annualized pace of 580,000 homes, according to the census and HUD. That's down 7.3% from April and 6.8% from a year ago. The median sales price was $424,900, and supply rose to 10.3 at the current sales price. That's not a small detail. When new home sales slow and months of supply rises, builders often have to get creative. And that can mean rate buydowns, closing cost incentives, price adjustments, inventory home deals. But here's the catch. Incentives don't automatically fix affordability because, hey, you still got to qualify for the payment. And the payment still has to work for you. And a house still has to fit the long-term plan. So
Exactly. The buyers are still out there. They're just constrained. When the math lines up, they move. So it's not about weak demand. It's about waiting until the numbers make sense.
Yeah. In Houston and Texas, this is especially important because builders have been a major part of the inventory story in Houston and in Texas. For buyers, new construction may offer opportunities, but you have to still take the full deal into consideration. A builder rate buydown can look great on the surface, but you still need to compare. And here's what you need to compare. Purchase price, rate outside of the buydown, closing costs, property taxes, HOA dues, insurance, And hey, here's another one, long-term resale value, because all of those incentives have been added to a base price. And so that means that I think I saw a statistics that upwards of 17.3% of the sales price on a new home is just incentives back to the buyer to try to create affordability versus actually reducing price. So that's where people get in trouble. They shop the headline, not the full math. And would you rather have a lower price or lower rate or closing cost help from the builder? Please drop me a note in the comment section. And speaking of math, let's take a break and get a message from our friends at Rate and the best mobile app on the planet at Rate. Thank you.
Looking to purchase a new home? The Rate app from Guaranteed Rate has got you covered. Once you've downloaded the Rate app, click to log in and create your password. This will take you to the intro page. Click the gray Same Day or Home Loans tile, and then click the red Apply Now button. Then click Start a New Loan. Begin by telling us where you are in the home buying process. Typically, for a pre-approval, you will click What Can I Afford? From there, the Rate app will load a series of simple questions. Answer each one the best you can as you move along. Once you've completed the application, your loan officer will receive a notification so they can review your information and set up your personalized checklist. The Rate app even allows you to upload documents right from your phone. It's just that easy. And if you do get stuck or have any questions, just give us a call. We'll be sure to get your questions answered so we can get you one step closer to owning the home of your dreams. The Rate app from Guaranteed Rate, simplifying life's biggest purchase.
Thank you, Rate. And hey, if you don't have the Rate app on your phone, go to www.mortgagemack.com, click on the QR code, and download your free copy of the best mobile app in the mortgage industry. Nothing comes even close. So let's talk about inflation. PCE rises, but may have peaked. Fingers crossed. If you're buying a home, refinances, or just trying to understand mortgage rates, this really matters because the PCE, the Personal Consumption Expenditure Index, rose 4.1% year over year in May, up from 3.8% in April, according to the Bureau of Economic Analysis. That's important because PCE is one of the Federal Reserve's preferred inflation gauges. In plain English, PCE is inflation for real life, for you, for me, and what we're actually spending our money on. Now, the headline number moved higher, and that's not great, but here's the possible silver lining. If energy prices continue to settle down and inflation pressures cool from here, we may look back and say, May was the peak. Fingers crossed. That does not mean mortgage rates will fall tomorrow, though, but it does mean the path to lower rates becomes easier again, subject to, you know what? Yeah. In Houston, the inflation story is bigger than just mortgage rates because homeowners are also dealing with property taxes, right? Which can be really, really high in Texas versus other areas. Insurance, too. We've been dealing with rising insurance costs, repairs, utilities, and overall cost of living. And I can tell you that from personal experience that one moment. We didn't have Soul in here. Sorry, I thought I had everything ready for today's show, but hey, it's a live show, and we make mistakes, and we just move on. Thanks. And so, Soul, why don't you go ahead and repeat what you were telling the audience with respect to the mistakes consumers make, please?
Of course, often consumers expect instant rate drops, but markets need to see consistent proof inflation is coming. The key is to plan your budget realistically, not just wait for a perfect moment.
Yeah, and that's why planning matters. What's hitting your budget? Drop me a note in the chat below. Is it mortgage rates, insurance, property taxes? I've gotten lots and lots of calls this year. And look, my clients call me when they have challenges on their mortgage, even in the servicing stage. And I can tell you that we've had lots and lots of lots and lots of payments go up due to erroneous projection of taxes into the future. And we've been successful at helping many of our clients mitigate that challenge. And so this brings us perfectly into this week's mortgage tip. Fixed rates or adjustable rates. I'm getting more inquiries in reference to adjustable rates, and most buyers don't need the perfect mortgage. They need the perfect mortgage that fits their life. This week's Mortgage and Money tip is simple. There is no one size fits all. A fixed rate mortgage means your interest rate stays the same for the term of the loan. And hey, that gives you stability. Your payment is predictable, your rate doesn't change, and your budget has more certainty. And that can be a great fit for buyers who plan to stay in a home a long time. And you want payment stability or simply do not want surprises? I do not want surprises. And let's be honest, most people prefer fewer surprises when the surprises involve money. Me too. Now, an adjustable rate is different. With an ARM, the interest rate is fixed for an initial period, and then it can adjust later based on the terms of the loan. That makes sense for some buyers. For example, maybe you don't plan to live in the home for more than 5 to 7 years. Maybe you plan on paying the home off in that same time frame. Maybe you expect your income to increase. And hey, you must and you need to understand the potential risk associated with an adjustable rate. And look, it's not bad. A fixed rate mortgage is not automatically better. The wrong loan is the one you choose without understanding the difference. So here's why strategy matters. At Team Mortgage Mack, we use E to the power 4, educate, empower, execute. Do a good job with the first 3. You're going to have a meaningful experience with us. And you know what? A pre-approval letter is not a plan. A plan answers these fundamental questions. What payment works for you? How long will you own the home? What happens if rates fall? What happens if they don't? What loan structure gives you the best balance of risk and opportunity in your financial life? And this is the conversation we have with buyers every day, every week. So here's my question for you. Would you rather have the certainty of a fixed rate, or would you consider an adjustable rate if the numbers and timeline made sense to you? Please drop fixed or ARM in the comments below. And if you're not sure which loan option fits your situation, send me a message and we'll help you build a plan. And before we close, let's slow the market noise for a little wisdom from our stoic friends. And this week's quote comes from Epictetus, and I remind myself of this all the time. What upsets people is not things themselves, but their judgment about those things. It's a powerful reminder in this market. Rates are rates, prices are prices, inflation is inflation. But panic usually comes from the story we tell ourselves about those numbers. A disciplined buyer does not ignore reality. A disciplined buyer studies reality, builds a plan, and makes decisions based upon preparation, not fear. Same for sellers. The market may not be 2021 again, but hey, that does not mean opportunity has disappeared. It means strategies have changed. And are you reacting to the market right now, or are you planning around it? Epictetus gave us wisdom. Now let's lower the bar and have a little fun with puns. So are you ready? So
Oh, I'm ready. Let's branch out with these puns. I'll back you up like the classic sidekick. Let's get them smiling.
what bored trees do? What do bored trees do? So
I think they branch out, really exploring their roots. Or maybe just looking for a tremendous opportunity.
it took me a minute to get this one. The janitor jumped out from the closet and went, supplies.
That one never gets old. And I've got a stretch for you. Me doing yoga? Now that's a bit of a stretch.
Can you do yoga, Saul?
Well, let's just say I can hold a pose like the tree pose. At least long enough for a pun.
Yeah, I'm with you on that one. So, and that deeply sophisticated note, let's bring this plane in for a landing. So thanks for joining us for this week's episode of What's Up with Real Estate. A big thank you for our sponsors, rate, HOA share, list reports, and if today's show helped help you understand mortgage rates, inflation, new home sales, or even loan options, hit subscribe, follow, and share with someone trying to make sense of today's market. And if you're buying, selling, refinancing, or just trying to figure it all out, a good smart move would be to connect with yours truly, MortgageMack and Team MortgageMack, and we'll help you build a plan, not a pitch. A plan, not a pitch. And join us here every Saturday, 10 a.m. right here, LinkedIn, Facebook, YouTube. Until then, stay informed, stay engaged, and I'll see you at closing.
Late nights, early mornings, he stays on the grind. Looking past the rate sheet for the value you'll find. Every signature means more than the dot you just sent.